Hello, we're going to look at chapter 26 in this short video. I'll talk briefly about what's important in this chapter as we go through these, I believe, 7 exercises. Let me go ahead and share that screen with you in Pearson My Accounting Lab. Let's see here. All right, there we go. All right, so what's important about this chapter, because I only pulled out just a small part of chapter 26, so it's really just a very small segment that we're going to look at. And primarily, we're looking at what's called the payback period. And payback period, this entire chapter has to do with capital budgeting. You know, there's usually companies have 2 budgets going on any given year. Operating budget, which is your revenue and your expenses, your income. But at the same time, if you've ever worked in business or one day you will, the other side is what's called capital budgeting. That's when you're taking your cash and planning to invest that into property, plant, and equipment or intangibles for the coming year. So these run usually concurrently, and this whole chapter is about capital budgeting. I know in the finance department they have a class that's entirely capital budgeting. But here in this chapter, we're looking at how do we decide, because we have limited amount of cash that we can spend. Most companies do anyway. So how do you decide which projects, which capital projects do you spend money on? And what we're going to look at here is payback period. It's very simple. Every company I've worked for, have done work for, tends to look at payback more than the other measures. There's several measures you can use. You can see there on our screen on this first exercise: internal rate of return, accounting rate of return, and also net present value. All of those are a little bit more complicated. Typically, when you're putting together a payback period, you're going to do the other 3 as well. All 4 of those are going to be on like an Excel spreadsheet with showing what these different returns are. But payback is simple. That's why so many companies use it. And all it is what is your total investment is your numerator, and the denominator is what is your cash return each year over the life of this asset that you're planning to invest in. And so all it does is give you a number and payback period, and it's in years. So if I'm going to spend $100,000 on a capital project, and I'm going to have a $50,000 return each year, what's my payback? 100,000 divided by 50,000 a year. It's a 2-year payback. It's that simple. So let's go ahead and go through these. The first one here, or second one here, is they're considering 3 options, or three projects: project A, project B, project C. Well, the lower the payback period, the better. That means you're getting a return on your money quicker. And so what you see there is what? Project A is the one you want to do first. Project C, you want to do second. And project B would be the last one. You know, it's funny, when I worked at Exide and Lear both, they wanted a payback period of 1 year on capital investment. It's hard to believe, isn't it? I thought it was just an Exide thing till I went to Lear, which was, Exide wasn't profitable, whereas Lear was very profitable. But both wanted a 1 year payback or they wouldn't invest the money. So I thought that was amazing. But all right, number 3. See what we've got here. This White Valley River Park Lodge, trying to decide whether or not to spend $11.5 million. And it says that following estimates assume that they use straight line depreciation. All of that's pretty much irrelevant. Expected annual net cash flows, because what do they want? They want, well, there it is. The average annual net cash inflow from the expansion is expected to be 2.892254. So they give you a lot of information, but all you care about is what's the cash inflow annually. And this problem assumes it's the same cash flow every year. We're going to get to one. I think it's the very last exercise. But what if you have uneven cash flows? That's where it gets a little bit more tedious in trying to calculate it. But if I'm investing 11.5 million, there's my expected annual net cash inflow. I've got a 4-year payback. All right, so a lot of this other stuff's irrelevant. How much did I invest? How much cash? What's my cash coming back in? Cash out, cash in. How long does it take in a payback period of years? All right, number 4, trying to decide whether or not to purchase new accounting software. Payback's $29,985. It's 3 years. So they're investing $29,985, and here they're telling you they want to pay back in 3 years. So what should our expected annual net cash inflow be? So they've just reversed the denominator, haven't they? And so this tells you we need almost $10,000 a year for a payback. You don't care about 12% required rate of return. That's when you're getting into those other measures. All we're focusing on in this chapter is payback period, because every company looks at that. All right, number 5. Looks like we got some projects here. And requirement 1, we want to rank these projects. So it looks like project N is 2 years, right? Trying to reach a $500,000 investment. So project N, 2 years is easy. Project M is 3 years. There's my 500,000. And then project L is 8 years. Made it very simple, didn't they? Even cash flows. Well, actually, that cash flow there is different, but it doesn't always equal out to what you're looking for, right? What if that'd been 100,000? Yeah, it would be, we have to do something different there, but we'll look at that on exercise number 7. All right, requirement 2. Other factors you consider. Yeah, there's always other factors to consider. Consider which project will generate cash flows after the payback period, right? So it's not just about making back your initial investment. How much you're going to save beyond the payback period? That's when you start realizing cost reductions or cost avoidance. So there's always other things to consider. All right, number 6, Rouse is considering a project acquiring a manufacturing plant, purchase price $1.35 million, expects to generate $329,000 annually. What's the payback? All right, 4.1 years. Okay, so that one was not 4, wasn't 5, so it's 4.1, but it was even cash flows. It says it will have to be replaced in 6 years. So the payback's well before the 6 years, right? That's a good thing. All right, and finally, this is the one a little bit trickier. They give you the answer there. It says that they're going to invest $1.476 million, 10-year life, generate net cash inflows of $310,000 the first year, $300,000 for the second year, and then $230,000 every year after that for 8 years. So what's the payback period? Well, I'm going to do it the easy way and just put the chart up there. So what you see there is, there's my investment. They've laid all this out, 1 year, 2 year, and then the remaining 8 years. What is my annual cash inflow from that outflow? Outflow, inflow. And so each year you need to accumulate what your return is. So first year's 310, plus the 300 is 610, plus the 230 is 840, plus the 230 is $1,070,000. Each time you're looking to see, are you up to 1476? All right. 1070 plus 230 is 1300, or 1.3 million, plus 230 is 1 million. Okay, so now we've gone beyond the 1476. So what does that tell you? There's 1.3 million in 5 years. And then you got to go somewhere into the 6th year, don't you? to get to the 1476. All right, so the return is not 6 and it's not 5, it's somewhere in between. So how do you calculate that? Well, what you do, you know, you got 230,000 that you're earning in year 6, so it's going to be 5 point something. So you got 230,000. Well, how much do you need to add on to 1.3 million to get to 1476? And the answer is 176,000. Right there's the calculation. 1476 is what you're targeting. 1.3 million is at the end of year 5. So what's 176 divided by the 230,000 that you're earning in year 6? And the answer is, that is 0.8. 176 divided by 230 is 0.8. So 5.8. 8/10 of that year 6. It's not 6.8, it's 5.8. All right. So that is chapter 26. Short and sweet. Payback period is very important. You're going to encounter that in your career. All right. Have a good day.